Cette conférence va maintenant être enregistrée.
Okay, that was the French voice. So, yeah, good afternoon, everyone. That's quite an interesting and important topic for all the startups. It's about the valuation, this session. And then on the 24th of November, we will have a more in-depth, going more in the details of the valuation, when Daniel will do his the other session. We do both sessions together, so Daniel might jump in from time to time, but I run now the main presentation here on my screen. But depending on which examples, etc., and if you have questions, so everyone can as well raise questions. It should be more like a workshop than just like an education session. This is basically the 4 points of the agenda, the 4 topics we go in. It's enterprise value and typical financial stage, then the milestones versus valuation criteria. So, and then we go I will share you some valuation methods which are typical for early stage investments, and we have prepared a valuation exercise which would be some homework for the next webinar. So, if you talk about valuation of a company, enterprise valuation, for an established company, there are basically there's an existing history. They have KPIs, they have a balance sheet, they have a profit and loss statement, and a lot of information is for an established company who has already revenue and production costs is available. And typically on the stock exchange, there maybe 90% of the valuation is driven by revenue growth, operation margin, asset efficiency, and maybe 10% by expectations. There are some companies which are still different. If we compare, for example, Mercedes-Benz automotive with Tesla, I have not done the detailed analysis on it, but I would make a bet that Mercedes-Benz, the shareholder value of Mercedes-Benz enterprise value is still a lot determined by this 90% driver and maybe 10% by the outlook of a new technology. And Tesla might be totally the other way around, because I think Tesla is still not profitable, but has quite a huge valuation on the stock exchange. If you now go to enterprise, to the startup situation, it's actually more the opposite. So it's all about expectations here. So 90% of the value coming out of the expectation and the potential you're presenting to potential investors. And maybe 10% can be determined by existing asset efficiency or by the revenue growth if you have the first sales already. So as you see, it's a totally different situation to stock exchange, public listed or existing established corporates and companies. And that's why that makes it so difficult. Then if you talk about valuation, that makes it so difficult for the startups to have like there's not existing like the one valuation method which one can really claim, okay, that's the truth of my value. There are always then a lot of different perspective and opinions about the expectation, about the potential, and so on. But there are still some possibilities how to structure the expectations, and this is now, for example, the method or the structure. I and the colleagues of Go Beyond Investing, I've been an angel investor since 10 years with. How we structure the expectations and how we try to find out in each of these areas what is the potential behind. So, and these are it's like a house, so the team is the foundation. So the team is always very important, and the team impacts all the other pillars of this house of value. And so it's a product or a prototype. So how advanced is the product? In which stage is the product if you present it to an investor? Then the market access is as well it's definitely maybe one of the most important aspects, and the industrialization. So how easy can your product be scaled up? How can it be globalized? How easy is the expansion in new markets? And in some cases, I think in your industry you are now in, there are as well then some regulations, and so you might in some cases might not be that easy just to set up or to set up a distribution company or distribution center somewhere and starting to sell your product in another country before you don't have achieved certain regulations, for example, so that you can do this. So all this as well impacts then the potential you're presenting. And then for sure the financial situation. I mean, if you have a lots of money, a lots of cash on your bank account, then with money you always can buy time on the development of a startup. But as you might already have experienced, the investors are as well not that relaxed, and normally they don't give you an excess of cash. Normally startups are always short on cash because typically the investors, they like to see the results first before they put more and more money in it. And then on the top is as well the board and the advisory team you have. I mean, this as well, this somehow is like the roof on it. It's maybe not on the beginning, maybe not the most important aspect, but it shows, I mean, if you get a good board and advisory team around you, this as well gives a lot of credibility in your idea, in your startup, in your venture to investors. Because typically senior industry people would not join a crazy idea, or if they don't, they all like to have a certain guarantee for success on it. And so the better and more senior the board and the team you can create here as well gives us a lot of credibility. And so what is then one of the most important driver of this valuation of a startup actually is the market access in a lot of cases. So because if you have a strong already a good insight in the market, that this is something which is very useful for an investor. As I said before, the product, the technology development, industrialization, the scale up, maybe a new design, or finding the right distribution partners for growing, for scale up, and the all these financial situations. So all these aspects you can find workarounds and there can be compromise on it. But then on the market access, that really makes at the end break or make the deal for your success, and that's why it's very important.
Klaus, maybe if I can jump in here.
Yeah.
I think one point that I would add in regard of your proof of this house in the board is the governance. And in my experience over the year with the startups, most of the time that startup have issues, it's because of the governance issues. That people are not aligned, that interests are different. So it's really something very important to put in place from the beginning as part of the package. And then the board is definitely one point of this governance that is very important, especially if you start having investors on board.
Yes, absolutely. Yeah, so it's right. So I mean, if you I think we mentioned it already in the last webinar. In a perfect situation, the investors who joining you in an early stage investment round with the investment, they really become part of the team. So it's like the first customers who are helping you to further develop your product and your idea, bring it to the market. So it's like it's on some hand it's like a first customer because you need to convince them about your idea. You sell it to them. I mean, the first people you sell it might just be the team. So if you are one or two co-founders, and then you need to collect 5-6 people around you. I mean, as well, this team, even they get salary, a little bit payment, but they still need to believe as well in this idea. And then the second or the first real customer might be then the investor joining. And the better they aligned, and then as well the same is then true for the board and for the advisory team. The better they aligned with everything you're doing, with your vision, the easier it goes for the next financing round. Otherwise, that might be. We have seen cases where startups that are then really crashing because of the misalignment between investors, board members, and the founder team. That's unfortunately sometimes the case. So if we now go to the next slide, this shows the development stages and the value of that. That's on the beginning of when you create your company, you might get grants, public grants, research grants from universities or from other institutes, and as well development grants from public institutions or from government. And so you might get this, but then this money is the cash, these grants are okay for a certain while, but then you come to the point where you need to convince investors to invest in it. And so typically there are friends and founders who invest, there are angel investors are coming next, early stage venture capital, then the more later stage venture capital and private equity, till maybe it goes to an IPO or a merger, so that the company is acquired from someone, from a bigger company. And the value of that is basically, there are a lot of startups, they get the grants, they do a certain development, but then they fail with the ongoing investments from getting from private people the investments. And this shows as well here, this slide, which is shows often the gap between the public and private funding. And that's why it's well so important that what I mentioned before with this market access. I mean, the sooner you can show that you have insights in the market, and you have access, and you have some pilot customers which are interested to test your product, your idea, or even co-develop the idea with your company, the easier is it then to find as well investors from the private sector and to close this gap or make it as close as possible, so that you're not coming really in trouble during that phase of during typically the first 12 to 24 months of a company. And this is here for the applied manufacturing R&D. I think that's typically the field as well. Most of your solutions, your solutions are in what you aim to deliver them. And here's more now the like an investor-oriented slide about the source of cash and the different development stages. I mean, the investors are always looking on the risk, and here you see the risk is high. They are in the early beginning, in the seed round, in the formation of the company seed round. There are the founders, family, and friends, as well that the grants and the government's prize money is coming in. That's in the early stage. And then as the company, as the idea is maturing and the prototype development is going in and the proof of concept coming in, then typically business angels are joining. From the investment amount, it's indicated here between 200K and maybe 2 million. That's typically the range where business angels are joining. And then as well here, then if the business angels typically they don't have the financial power to continue then in later stages, or it's sometimes difficult for some of them. And there's as well then a so-called equity gap, because venture capital firms and family offices, they have sometimes very clear rules at which stage they come in and invest. So how much revenue, and typically they like to see already some revenue, ongoing monthly revenue, stable revenue situation, and some other criteria. This has, lucky-wise, this has changed over the last 3-4 years a little bit. So there are now more and more, especially as well here in Europe, there are more and more early stage venture capital firms coming, or as well the more established venture capital firms, they started collaboration and moving more in the early stage sector, which hopefully over the time will close this gap more and more. But this is as well something you need to be prepared, and especially then, for example, around if you have business angel on board, and it might be quite good to check with them, whether they have planned as well sufficient cash on their bank account to support you on follow-on rounds. I've been in some investments where in the like 5 years ago, when I made my first investment, the lead investor who accepted us as co-investor, who accepted the business angels, it was a family office, and then he accepted some business angels as co-investors. But he made it very clear that he said, look, the same amount you invest now, or 1.5 hundreds, 1.5 of the amount you invested now, you need to keep for follow-on investments for the next 5 years. In reality, it was now even more than, as always, the situation is very seldom like a plan. But at least everyone was prepared to it, and it was then not a big issue to even to raise then a little bit more of the money. So it created not only immediately this big financing gap if in a follow-on round. Certain investors who, because the early round, the seed round was they got quite a percentage of the company, and if they even then not fill the pro rata, this creates then a huge gap for other investors, which then might not be able to close the gap, and then you are in a very tough negotiation situation with potential new investors who need to join, especially venture capitalists and as well family offices sometimes, and strategic corporate investors. They are very fast aware about whether you under a financial pressure situation or whether you can see it more relaxed, because you can, at least the pro rata, you can already cover with existing investors. And here you see the lower the risk, the bigger the rounds, and as well normally the easier it gets to collect the cash and the money. So if you keep the same scheme and say look to the milestones of the financing and evaluation stages. Typically, evaluation of the opportunity. So that's when you evaluate the opportunity, when you do some research, that's typically here, it's still on a high risk. You might develop then for sure the business concept, and then you start with the prototype. And there already for this business concept prototype, you need to have a seed round typically. And but this as well has changed over the last 2-3 years. In my observation, that we see now more and more startups already coming with a prototype, because there are more and more possibilities as well with 3D printing and then other possibilities, where they can with very few investments from out of their own pocket, for example, they can bring already a prototype and can demonstrate a prototype to investors. So if they're coming with a seed round, they already bring a prototype. So this is the trend we have seen over the last 2, 3, maybe 4 years. And I think this is will continuing, that we more and more, when startups coming looking for first-time investors in their company, that they then already can demonstrate more and better what the product is doing, and that should as well make it more easier for convincing investors in an early stage round. Then the risk goes down, but then it comes the product launch, the pre-serial production, which still might be craftsman works in some cases, and then you need to think about the serial production or the scale up. And as well, serial production and scale up is then about are you staying in a national market or in a region, go you national, and then the next step would then be a serial production with the international expansion. So this is basically now the milestones and the different stages. So on the beginning, it's the idea hypothesis. Then you come on the value hypothesis. The value hypothesis, on the value hypothesis, you need to prove the value to your customer, that there are customers that are willing to pay the price. And so this typically this information or this hypothesis gets proven by the product launch, by the pre-serials that you collect this type of information. And then you have the growth hypothesis. These are basically the 3 hypotheses you have for your startup. And you need to prepare to demonstrate as well your assumptions on either of these hypotheses. And investors might have as well certain benchmarks, depending on the market, the business model you're trying to achieve or to use and to achieve the KPIs. They have then benchmarks, especially the venture capital investors, because they see a lot of these cases, and they have normally a huge database where they can run benchmarks on it, and as well challenge you on this hypothesis, whether this is possible or not, or based on what they have seen. If we now take these milestones versus valuation criteria, say, okay, these are the same stages: evaluation, opportunity, business concept. On the left side, you see the prototype, product launch. It's just in a vertical axis, and then you have the hypothesis here as well listed, and then you see on the right side you see the typical criteria and the deliverables per milestones, jumping from the idea to the value and to the growth. So it's you see the business model canvas on the beginning, then as well IP and patents, business plan and financial test results from the lab, so that you can really maybe as well from an external source these results can be checked and can be certified or approved. Then the board and the advisory team, that's, as I mentioned before, that's as well quite an important criteria in the value creation of your company, especially if you now jump from the idea to the value hypothesis. So here, if a good team is, if you achieve to assemble a good team around at this stage, that's always a very positive feedback. And then on the value hypothesis, you get the customer feedback, you get sales feedback from your sales team as well. You get confirmed financials or metrics, certain metrics, and here as well, it's sometimes depending on your business model, but for some business model, it's very helpful if the KPIs and the financials are the structure, how you report what KPIs you are, information you're gathering, how you measure the KPIs, together with the financial situation. If this is then in one Excel sheet together, that is well then quite helpful for investors and to confirm this, to see the history, how over the last 12 months this has developed, and then to see, okay, if we run more marketing, then typically then the sales sales metrics, the sales goes up, or if we do this and this, if we do more educational sessions with our customer, then this impacts this and this KPI here. So, but if this is then stick together in one Excel sheet, financial and the KPIs, that's as well very helpful, where you can as well demonstrate that you have thought from the beginning about the structure, how you would prove and demonstrate and how you would measure the success of the company. I've seen some cases where startups after 1 year or 2 years, they have changed the reporting structure. And then when we came in and made due diligence and tried to understand how the history was of the company, then it was very difficult. And then it's, I mean, then as well, a lot of investors are not that keen to spend a lot of time to understand why all of a sudden things has changed and how the picture goes together again. Even you might have a good explanation about it. It's not a good practice. It's a better practice to have from early on always the same structure and demonstrate how you have seen how your assumptions and your hypotheses have been, how you defined them and then and how you track them. Now we are coming to the valuation methods. At this until up here, any questions to here now from your side? Otherwise, I just continue. Okay. So on the valuation process, we have the pre and post money valuation. This slide just shows then the difference between these both. So if you have typically we start with a pre-money valuation. That's the valuation of the 100% of the company of all, so the amount of shares through the valuation before the investment is made, the next investment, and then the cash comes on top of it. So that's then the pre-money valuation with the injected capital, with the funds, with the new funds. Is then the post-money valuation, which creates then the post-money valuation with additional intangible value, basically creates then the next pre-money valuation for the next round. I have seen some cases when there is like a very dominant investor who has a bigger portion of the shares in an early round, and they sometimes, I've seen this with a family office, for example, that this investor then, for him it was always a little bit the same calculation. So he took always the post money of one round and said, okay, this is the pre-money of the next round, which would imply that there's no intangible value creation, there's no additional value created, because his assumption was, if I invest 2 million and you consume this 2 million with your employees, that's then the value which is created. There's no additional value. It's just the value created depending on how much of the money of the investor you have burned. And that's I think it's quite you only can avoid this situation if you have investors with not a dominant investment share in the company, so that you as well can, if you invite other investors, new investors to the round, and they accept, and the other investors as well, if they accept then a higher valuation, higher pre-money valuation, then that's the only way how somehow you can avoid this, that you got not totally dependent on one investor who is basically determined by his approach, and even it can then go in a down round that the investor is even in one of the, if you don't meet certain milestones, then you might even just accept less pre-money valuation than the former post-money valuation.
In that point, that's the reason why I always say to the startup, do as well a due diligence on the investors. Not just the investor does a due diligence on you, but do it as well on the investor, and make sure that your goals and then your strategy are aligned, because then you can expect him to reinvest, or as Klaus was saying before, that it's not just a one-off an investment usually. And if you have an investor that is committed to your vision, then he's going to be willing to invest later on as well. So make sure that he's as well committing to that in some way, that he's on board with you in the journey. Because so for the next round, you have already an investor that is committed to invest, and it's much easier to raise additional money.
Mm-hmm. Okay. Then to the next slide. The next slide now shows the what happened here now. Okay. Okay. I don't know why, but I cannot now.
I think you have the pointer now.
Yes. Okay, now it's done. Okay. Yeah. I could not skip the next slide. So the valuation process and here we have the valuation methods, the different, sorry, here I see the heading is wrong. It's the valuation methods here on that slide, no longer the process, it's the valuation methods. So these are valuation methods existing. So there's the business angel rule of thumb method, which is based on some experience comparables for the business angels apply. There's the asset-based valuation, liquidation valuation, replacement value, which typically can only be applied more on the later stage of a startup. So basically, in software development, I've seen this with software companies. I've seen this from time to time, that investors basically make the calculation: how much money do I need to? How much would it cost if I ask another team of developers to develop the same solution? That's as well, I think, a little bit a tricky, in the early stage, a tricky situation, which might not be really fair, because the first time developer, they pay additional efforts, etc. And maybe the second time, if you see an idea, then it's always easier and might cost less to just copy it, and so that's why the asset-based is, in my opinion, not always the fair. But in a later stage, if there are really assets available, then it can sure be used. Then we have the discount cash flow. For the discount cash flow, you need to have reliable cash flow, positive, negative, over the next couple of years. Typically, this would require that you have revenue and as well the growth per year can be somehow measured. So you need to have some history on the revenue and annual growth. So that's typically as well a method which is used more on later stage if you're already in an international expansion, for example, then it can be used. But still in the setting up the company, establishing the company in a certain market with the revenue projections, it's not really a reliable method. Then we have the venture capital methodology. This is how venture capitals basically they calculate or they take a look what multiple in their portfolio they need to achieve to make their investors happy. And then they make a backward calculation and decide, or then they come then with an offer and say, okay, this valuation is okay for us. And this can really depend on venture capital firm to venture capital firm, because depending on the pressure they have in their current portfolio, they might change the expectation on the multiple, exit multiple, etc. quite significant. So it's not like if you go to 5 venture capitalists that the venture capitalists with the venture capitalist methodology, they come all to the same value. That can really be as well totally different. As I said, because they take their own situation and how much pressure they have from their investors, and then they bargain basically whether you accept this value they offer to you. Then for sure there's as well the comparables to other startups. This is as well something, as I said before, venture capital firms or as well angel investors, depending whether the angel investors, how active they are, how much investments they've done, or like with Go Beyond Investing, we have as well the insights, even if I'm not invested in all the 100 startups Go Beyond invested as a community I still get then the benchmark data of a lot of these startups, so that we somehow can compare whether is this a fair offer, this valuation, or whether is it totally out of sync and not acceptable. But this is as well a feedback we give them to startups. For example, we had already cases where we showed them to startups and say, look, there are 4 or 5 companies approached us over the last 6 months, similar business model, similar industry, maybe a little bit different solution, technical solution, but still trying to achieve the same value proposition for customers. And they have asked for this and this valuation, and you are coming now with totally more. So please explain what makes you so different, what is really the difference. And if you have good arguments, then this might be accepted. But I have seen in a lot of cases that there was then a pushback, or we declined if the startup was not willing to lower the valuation in some cases. Then we did not took the risks to go in with a too high valuation, in our opinion. And then there are the industry benchmark sales and earning multiples. That's something very interesting then for the exits. So basically the industry benchmark and sales earnings, that goes sometimes together with the venture capitalist methodology, because they collect this data and they use then this data of the earning multiples basically for the backward calculation to determine as well the value. And then they make basically a cross-check whether this exit potential would still fit in their portfolio return. So they do basically use them this as well as a cross-check. So here now we go in one valuation method, valuation one, which is a risk discount rate applied to revenue.
Klaus, if I can add some of my comments on the slide before. He says that what you can see, there is not a method that you can apply and that's it. I think it's for valuing a company in early stage or in the stage that as you are, is very difficult. It's very tricky. And then so usually what we do, we use different models at the same time and try to see, okay, do we get more or less to the value that we would expect, or is any method completely out of the range? And at the end of the day, it's as well among all the investors, among the company, it's a negotiation, and they should fit the complete investment strategy going forward. So you have to take into account that you will have future rounds, and then this needs to be in a price in a way that it's still interesting for the later investor to jump in, so that your pre-money valuation is not too high for him at that point, so that you won't get money. So you have to think it more as a long-term investment, so to say, as part of your investment strategy, if that makes sense.
Yes, so I mean, on that slide, for early stage investment rounds, it's basically the business angel rule of thumb. I think it's a very frequent used method, and the venture capitalist methodology. I think these are the most used for early stage, and all the other cases can be used for cross-checking and to verify data. And I mean, it's very good that you do the calculations with different methods to be well prepared in a rational discussion and negotiation with investors, so that you not just need to believe or accept what they come, so that you as well prepared yourself in a way that you can as well negotiate and discuss, and maybe convince them that because of the industry benchmark, because of the compound annual growth rate, for example, in a certain industry, that your case might look far more attractive from the potential than maybe other cases. But so that's why it's very very good to know that there's not just one method. It really is sometimes a combination. But for early stage, the earlier it is, the more common is the business angel rule of thumb methods and the venture capitalist method. And this is now on the very simplified risk discount rate applied to revenue. So if you plan to have like 10 million net profits in 4 years, for example, and the investor might think that your case, every second startup might achieve this promise in 4 years, making 10% net profit. So then the risk discount rate, so that would be then he would value this profit with 2 million from now. So it would not be the 10 million he put in, because he said, okay, it's a 50% risk over 4 years, that gives me like a 2 million. And then he might still go and say, okay, the revenue or the profit multiplier in this industry is by 7 or by something, and so on. That might then determine the valuation of this round, the pre-money valuation. But it might be as well. I mean, the uncertainty here is really about how much risk they think they have when they invested. So how big is the risk that you achieve what you are promising or what you plan to do? And so that's, as you can see, it's really still, even it applies a certain percentage, and the discounting, it applies certain mathematical certainty. It's in reality, it's not. It still depends a lot of the perception, the perceived perception, and the expectations and the potential they see in the company. The next one is so this is well. I mean, this is well an easy method, which is basically used from business angels as a rule of thumb. So let's say, okay, in 4 years, this is the revenue. Then I discount it. I see the risk either here, or I see the risk at 70%, and then I apply this and this. So this is basically part of this business angel method. Here, the second method as well. It's a business model and metrics. This is already here. The investors need to have already some experience about with a certain business model and with certain metrics, so that he can then basically on the achieved milestones or on the results, for example, 10,000 downloads or 10,000 monthly visitors on a certain platform, that he might then say, okay, this has between 200 and 400,000 value. If you come to 100,000, so 10 times more, then it's 400k to 800k. So it's not that this is a linear behavior here, a linear curve that the 10 times more download is 10 times more value. It's based on the experience, and then if the first 1 million downloads are achieved or monthly unique visitors, and then they might value it with a couple of millions because there are certain thresholds achieved, which then all of tipping points achieved, which then all of a sudden might that the valuation is jumping to a certain level, which is then accepted. And this can be, I mean, there are a couple of examples available where then the investor might discuss and say, okay, in this case, we have seen it's developing like this and this, so why should you be different? And sure, and this valuation also depends a lot on the uniqueness of your business model or what you're offering, on the ability to export to other markets, that I mentioned that the business the market access before, and the size of potential local markets as well. So these are as well the impacting for sure the valuation here with that business model and metrics method. This model is basically is quite used for app downloads or for platforms or for internet value of internet business models basically. And then we have here we have now more on a technical engineering based product, for example, where depending in which country, I mean, this really depends a lot from country to country. There are some countries they have higher numbers here on the stages, and other countries they have far lower. But for example, in Germany and Switzerland, I think that's the range for a sound idea. If you just come up with an idea and asking for the valuation, so that's between 100 and 500,000 mainly. So it's really the very early start of your venture. Then if you have the prototype, then you add 500k. You can have 500k, maybe a little bit more. It depends how complex and how sophisticated the prototype is already, so that you really can demonstrate the full value of your product, for example. Then it might go higher. And then it comes again the management team and the board. If you have a high quality team assembled here, this I mean, this is not really adding any technical function and features to your product. It's really, that's just the trust then that these people put in you and your prototype, which is raising the value between 300 and 1 million plus. So if we add up here, we are around between 1.5 and 2 million at this stage already with a prototype, a management team. And then if you have, depending on how strong your patents are, then you can add 1 million more. So you're coming to around 3 million, 2.5, 3 million here with the seed round and valuation in the seed round. And then if you have then already first pilot customers and roll out a solution already, first success here in a still limited market, another million is added to the valuation. So these are valuations as a rough guideline. It's for sure it's absolutely not as any method. It's not like that you really can say, okay, this and this, but we have achieved this. So it always needs the other side, the investor, to accept it. But it gives it's as I said, it's a rough structure, rough guideline how the valuation is developing over these different stages of development. Here we have now an example of the venture capital method. So, for example, here the venture capital company is anticipating an exit around 100 million. They have a return of investment in their portfolio from, they say, 20 times the investment amount needs to be achieved. So it's the post-money valuation is 5 million. And then from this 5 million, they reduce their invested amount. So they invested 1 million. So the pre-money valuation before for adjustment for dilution for them would be 4 million in that case. And then they anticipate a dilution so that they not so that ESOP and as well they might not continue for all for all the different fundraising rounds with the full pro rata amount, so to keep their shares in the company. So they adjust for the dilution, and then they come to a pre-money valuation after adjusting for dilution of 2.8 million, for example. And this, as I said, this depends here on the target return of investment they have in their portfolio, what they're promising as well to their investors, and this might be varied. So there might be instead of 20 times, there might be 15 times, there might be 40 times, 50 times, depending how aggressive and what they promise as a return and how the situation in their portfolio is currently. I mean, if they have already some early failures, wrong investment or investments done which are not successful, that puts then a higher pressure on them. So that's why each venture capital company might come up with another value. So it's not that this 2.8 million is then the right value for each of the venture capital will come up with that value. Okay, so these are the examples which are typically in an early stage situation used on the valuation. Do you have at this point any questions? Anyone? Or did you make any experience already with some of these methods? If you go back here to that one,
Klaus, I have a question. Yeah. So on your first method, how did you define your risk discount factor?
As I said, I mean, that's basically the assumption the investor takes. If you say, okay, in my experience with this business model, maybe only every second startup will achieve in 4 years this type of net profit, this amount of net profit. That's really as well an assumption, and which is so you cannot basically say, yeah, we have this business model. And that's why we can be quite sure to make the 10 million. So it's really that he compares it with a lot of other factors.
Is this for a specific industry, or it's like for all kinds of startups?
That's now, I mean, that can be applied for all kinds of startups. What the industry factor comes in is then if it comes to this 2 million, that is okay. The revenue what you try to make in 10 years is for me now I value it with 2 million, and then you can say, okay, and this typically I multiply by the industry multiplier, which might be from a benchmark database we provided. For example, yeah, that you know, there are benchmark databases which say net profit, a company with 10 million net profit has been sold for 50 million, and so, or for 100 million, and so you would say, okay, it's like a 10-time net profit multiplier in that industry, and another industry might be higher or lower, depending always as well on the growth projection of the industry itself, how strong this industry is perceived to grow in the future. Is it clear?
This is a very good question, and in my experience is as well dependent how is the feeling, or when you do an evaluation or evaluation of a company, what is your overall feeling, how achievable is what they are promised that they will achieve, and at the end you start playing around a bit with the numbers, and you do some sensitivity analysis, and at the end you come to a place that you say, yes, I personally would put this project in this discount rate bracket. In my experience, that's the way it works. But there is no right and no wrong in this. It's just since it's so difficult, it's just about that applies on the future promises. So it's very tough to calculate. To say that's for this industry is like that and that. It all depends on the house that Klaus presented. What are the different pieces of the house, and how do you get everything together? How solid is that?
I interrupt. So I just saw that Max had to leave. I think he tried to ask a number of questions, but I guess he will move to his question during the individual coaching. So I would like to leave the floor maybe to the audience before we conclude, because I would like to take a few questions maybe. Are there any questions in the audience right now? It's already 3 o'clock.
We will, just from my side, we will send this valuation exercise, which just that each of you can prepare working on the valuation for the next for the coaching session and so for the next webinar.
Okay, so I'll let you explain this exercise, and I have a couple of questions for conclusion.
Unfortunately I need as well, like I'm out of time now, and I still have another call, another session with someone else. So I mean, it's very quite self-explaining. So each of you should think about which methods used for evaluation. Please discuss within your team what are the driver for your evaluations, or what are the assumptions for your evaluations based on the house of the value, or what we have in the beginning of the presentation here, and then doing some calculation. And then if you come back, then we can discuss either on the coaching session, we can discuss your evaluation, your assumptions, or we can as well on the next. I think Daniel, you had as well prepared some discussion in your session then based on this evaluation exercise then. And it's well quite important then that here on that slide, you see we made here an evaluation example over the first 3 rounds of a startup. And here is, and that's as well quite important about your own dilution. So how much will you dilute as a founder after 3 rounds? What is the shares of the startup investors? What is the shares of a potential strategic corporate who is joining? So that you all these factors you are calculating in an example, how ideally an evaluation and the fundraising would look like in your case. So because that could be as well used as an input for the fundraising strategy in general over the different rounds and steps. Okay, are there any questions? I think people might as well leave now because we're already out of time. I need as well to leave. Is it okay that we can stop here, or if we send them? I mean, we have the coaching sessions where you can ask the questions as well.
Okay, can you all switch on your cameras, please? Who needs to leave? Who can stay?
I need to leave.
Klaus needs to leave. So who can stay among all of you? Yeah, we
have about 10 more minutes, more or less.
Okay, so Klaus, maybe we can say goodbye for now, and if there are some questions, we'll try to answer with Daniel.
Yes, I mean, Daniel is fully aligned on that material. We put it together, assemble it. So yeah, okay. Then I look forward to the next coaching sessions and then and to the next webinar. So if I step now out here, I stop sharing my screen, right?
Thank you, Klaus. Great work.
Bye bye, everyone. Bye bye.
Thank you.
Thank you very much.
So yeah, I would like to take some questions from the audience. I'm sure you have some, or maybe you need to digest information before. So what are your thoughts?
I think that at least in my case, it would be beneficial perhaps to have a look at 2, 3 such cases of valuations to get a more feel of how the theory translates to numbers in real life.
You mean examples?
Yeah, real-life examples, right, of companies that shared that information.
It's not always easy. You understand that there's a lot of negotiation in it, there's gut feeling, and the secret behind a negotiation is always something difficult to go through.
Yeah, of course. But if you know there's epic failures or epic successes, depending also from the point of view of the investors or the founders, then it will be interesting also to learn the extremes in order to get a ballpark of what is reasonable.
In fact, I think that part of the answer, so the valuation is one thing. Now, what you can negotiate into your contract with the investor will be mainly discussed by Daniel during the next webinar. This is really what are the accretion mechanism, dilution mechanism, all the different financial tools that exist that can be beneficial either to the investor or to the founders. And that's where you can maybe in the negotiation reduce your valuation, but if you outperform, if you have a very outstanding performance in your company, then you will take some shares back. And for that, there are some mechanisms for that. So the valuation is one thing, the negotiation is another. So there's not a pure. You can agree maybe on the low value for during a round, depending on what you get to increase your shares in this process.
And in my experience, it's essential that you don't try to maximize a round, that you take really the whole process until the end, until the exit from the beginning. Because what you don't want, or you have to try to avoid in your journey, is to have a down round. It's when you have to go and tell your investors already put some money in you that now the shares is not worth what they paid for. And to not to do that, that means don't be greedy. Don't be greedy at the beginning, because you want people to work with you to get smart money, to have investors that are not just in for the money, that in for the values, that in for your goals, for your just cause, and this is about. It's not about now closing a round with the maximum amount of money, in my opinion.
I will stop the recording, but we can keep on discussing.